Welcome, everybody. I'm J.Thelander. We're here with PitchBook and Cooley today. We're going to give you a minute all to trickle in, and then we will get started. Great. Well, our numbers are rising. Actually, Emily, I think we should go ahead and get started. I'm J.Thelander here today to our PitchBook and Cooley investment firm webinar. And I'll go over a few. This is being recorded and we will send out a recording. And also, we would really love this to be interactive because we've got a lot of great information. We are focusing obviously on compensation today, and we will we have someone monitoring the chat. So as you have questions or if there's something that you would like us to pause on or discuss a little more in depth, please let us know and we will make sure that we address your questions. And I'm going to introduce Emily, who is a senior venture capital analyst at PitchBook. Emily, this is our second go round, so I feel like we're the OGs of the house here. And I'm going to turn it over to you to get started.
Awesome. Thank you, Jody, for the introduction. Today, I will be giving an overview of the current state of venture in the US. I will cover three main themes: deal making, exits, and fundraising. But before we begin, I would like to introduce PitchBook to those who may not be familiar. PitchBook is the leading resource for comprehensive data, research, and insights spanning the global capital markets, including PE, VC, M&A, and emerging technology spaces. You can learn more about our platform and new features at pitchbook.com. Now, let's take a closer look at the current state of venture, starting with deal making. The pandemic era highs of venture investing, combined with declining exit activity since interest rates first hiked in 2022, has led to the highest number of VC-backed companies to date, totaling over 58,000 as of December. This huge population of private companies is elevating deal activity. 2024 deal counts and deal value surpassed pre-pandemic and 2023 totals, crossing $209 billion across over 15,000 deals. Even though these figures are not on par with 2021 levels, they reaffirm that there is still a robust amount of capital going towards startups. This is a promising sign of recovery, fostering renewed optimism for 2025, especially since the Fed is expected to cut rates 2 more times this year. Quarterly deal value reached a 10-quarter high in Q4, with nearly $75 billion invested across an estimated 3,800 deals. Though the worst of venture's downturn may be behind us, the road to recovery is expected to be long. The next 4 quarters will most likely see slow and steady improvements in deal-making activity rather than an immediate rebound. The increase in outsized deals was the primary driver of 2024's deal value, so Venture's recovery was heavily skewed towards the top performers and AI companies. Only a handful of companies make up a major proportion of deal value. Venture-backed AI companies were the primary driver of deal increases in 2024, capturing 46% of the year's deal value, as investors were driven by their fear of missing out on the next technology wave. Companies are also finally coming back to the market to raise new financings. The time between rounds for all series hit decade highs in 2024, with the Series C and Series D plus rounds surpassing 2 years since their last investment, which aligns with the market peak. With the influx of investor dollars in both AI companies and AI-focused venture funds, as well as the return of companies that last raised during pandemic-era highs, valuations and deal values will likely remain elevated in 2025. Jody, do you have anything to add before we move on to exits?
Yeah, thank you, Emily. And really what we're seeing here on the private company side. So we here at J.Thelander, our survey data is real time, and it covers both the private companies as well as the investment firms. And we're absolutely seeing that private companies is taking longer to raise capital. And when they are raising capital, they're typically raising more. So it's been a really slow and steady market. And that is reverberating down to how companies are structuring their compensation. And it's also impacting how the investment firms, how the sponsors are structuring their compensation around carried interest and their vesting time. So we'll delve more into it. But what you were saying in terms of the business is also tracking in terms of the infrastructure and the approach that both the firms and the portfolio companies are taking.
Great insights. Thank you, Jody. And now moving on to our second theme, which is exits with a focus on IPOs and M&A. The lack of liquidity continues to be venture's primary obstacle. The venture market was hopeful that the Fed's 3 rate cuts would spur more exits, but so far they have not moved the needle. 2024 had over 1,200 exits with an aggregate value of nearly $150 billion. And though this is an increase from the past 2 years, exit value is significantly lower in 2024 compared with the pre-pandemic era. Exit counts are similar to 2019, but exit value is actually less than half. And nearly 42% of the value can be attributed to large billion-dollar exits that make up only 1.7% of the total count. The largest public listings and acquisitions were from the healthcare and information technology sectors with an emphasis on AI. Amid a prolonged IPO drought, M&A has played an increasingly important role. However, many of the M&A deals in 2024 were small and generated low returns. The FTC's recent leadership change should create a more business-friendly environment that will encourage more activity. We expect M&A and IPO activity, and as a result, distribution rates, to moderately increase in 2025 if rates are cut as expected, since they would lower borrowing costs and pricing expectations from sellers. Our expectations are tempered, though, since many startups have chosen to wait for a friendlier exit environment due to market volatility, low demand for companies at high valuations, mixed post-IPO performances, geopolitical tensions, and uncertainty regarding certain policies from the new administration, like tariffs. For now, the distribution rate of 6.5% is significantly lower than the 10-year average. Because LPs often rely on cash distributions from exits to fund their subsequent investments, fundraising has struggled as a result. Jody, do you have anything to add on exits?
Yeah, we are definitely seeing that private companies are staying private longer. And in our private company data set, we now have the total amount of financing upwards of 500 million plus, because we started seed stage, right, of under 5 million. And we like to look at it by the total amount of financing versus series of financing, because you never know what a series of financing could be, because these bigger rounds, since they're taking longer, not everyone's Series B is the same as Series C, but exits are definitely taking longer. Private companies are staying private longer, and they're raising more capital. And we'll turn this over to Rachel in a little while, but maybe Rachel, you have a comment. Rachel, by the way, is a partner at Cooley, and she serves as fund counsel on the outside. But you're seeing that, we're seeing that LPs are really concerned and also more cautious around putting money into venture funds. So what's your take on that?
I think that's right. I mean, we're seeing LPs continuing to ask, like, where's my money? They want to see DPI distributions over paid-in capital, and that's just been lagging and slow the last couple of years. And so they're kind of waiting. Obviously, they're continuing to put a lot of monies in the winners and the A++ firms, but everyone else is really, I think, waiting for the capital to come, and it's taking a little bit longer. We'll go into the fundraising next, but it's taking a little bit longer to fundraise, more closing. The period is a little longer as LPs are waiting for exits and distribution.
Great, thank you. All right, Emily, we'll let you move on to fundraising is the next chapter. So perfect segue.
It's really the perfect segue. So let's dive into the data. Venture funds across the board have emphasized that liquidity is their biggest hurdle to raising additional capital in 2025, like Rachel said. And until exits occur, fundraising activity will remain relatively stagnant because LPs are either unable or unwilling to allocate more capital to venture. And fundraising was slow in 2024, with $76 billion raised across over 500 VC funds. As LPs become more selective and cautious, established firms with brand names have commanded a competitive advantage over LP commitments compared with emerging managers. Established managers have secured 79% of fund commitments year to date, which is the highest concentration in the last decade. And as a result, emerging managers without robust track records have struggled. Over 1,000 funds were established during the fundraising highs from 2020 to 2022, but VC's lackluster performance since then have left these managers in a tough positions because they don't have large wins to bolster interest in their next fund. And sensing decreasing LP appetite, many managers that have yet to deliver LP returns are opting to wait before fundraising. The number of first-time fundraisings has plummeted to decade lows as few aspiring managers are able to garner enough interest. The dominance of established funds will continue until there is a greater and more consistent flow of dollars. LPs need to first recoup their deficit between capital calls and distributions from the last few years before committing to more investments. But once these headwinds decrease, we expect to see first-time fundraising activity recover as some VCs from large firms spin off to create their own funds. However, this may not happen until a couple years down the line or until after the market fully recovers. Jody, anything to add before we move on to the outlook?
Yeah, I couldn't agree more. And Rachel, feel free to jump in here what you're seeing from clients, but we do know this to be true because it is impacting from our angle on the consulting that we're doing with investment firms, both venture firms as well as corporate venture firms, but predominantly venture firms and family offices, is that the capital calls are, that and without the returns is definitely impacting people's pocketbooks, so to speak, and it's slower to raise more capital. There's no question without having the liquidity market. Rachel, what are anything specifically you're seeing with clients here to add to this?
Yeah, excuse me. Yeah, it's definitely tougher for emerging managers than it was a few years ago. Although I see a few like really bright spots. We have fund ones that are actually oversubscribed and overcommitted. It kind of depends on where you're coming from. So if you're coming from a really top firm and you're a great manager with great track record, investors really want to say to themselves, who's going to be the manager, the top manager in the next 20 years. And so they're willing to back those fund ones and fund twos and get a lot of excitement around them. I think it's maybe harder for operators that now to start fund one than it used to be. But there are really bright spots and real excitement around the managers of tomorrow. But it's definitely tougher and it's a little bit of a grind. And if you're surviving, you're thriving right now. I think it's maybe the message.
I think that's a great way to look at it. I couldn't agree more. I mean, we're working with a client right now, and they have been both successful investors as well as operators who've had full liquidity in a portfolio company or several companies, and they are oversubscribed and just killing it. So I agree. There are people who are those who are doing this are thriving, but it's really separated the people who have had lack of experience and success from the people who are really stars.
Yeah, the other thing I hear that's interesting too is obviously it's a lot easier to return, right? A $20, $50 million fund maybe than it is to return a $7 billion fund. So people are looking at multiples and wanting that DPI and saying, hey, if you got a huge winner in maybe a pre-seed seed stage fund that's smaller, hey, we might get to see some more action back quicker. So that's another thing I'm hearing.
Yeah, very true. And there's a big discrepancy between the haves and the have-nots right now, which is one way to restate what both of you said, which is great insights. And now let's move on to the outlook, my last section. And looking forward, the frequency and magnitude of the Fed's interest rate cuts will determine how much relief venture will get from the downward pressure from the past 3 years. Until then, we expect these trends in deal making, exits, and fundraising to continue as investors remain cautious. The good thing is strong companies are still attracting investor interest, The highest quality companies with healthy financials, strong management teams, and a solid product market fit are still able to raise capital. Companies just have to make a stronger case to investors to justify their high prices. And another good thing is there's ample dry powder and a large backlog of companies waiting for friendlier environments. Once the venture market eventually rebounds, we expect to see a sustained level of activity as companies finally exit, LPs receive their distributions, and money is funneled back into venture. So thanks for your time, and I'll turn the discussion back over to Jody.
Perfect. Thank you. I'm going to go ahead and share my screen. So once you're done, perfect. Great. Well, we're going to move into, all of this, obviously the purpose for this panel today is to talk about how the markets and the compensation sort of segue and to make sure that we answer questions and provide you with data and guidance. So with all of this, we have been partnered with PitchBook now for 10 years, and we cover investment firm compensation. And I'm going to move into our deck to share this with you a little bit on sort of the data that we have, which is available to all of you, at least a subset of it for no charge. It's a give to get model. So if you participate, and Morgan on my team is going to put in the link here. So for those of you that are PitchBook subscribers, you just have to talk to your client success person and you get access to this for even if you don't participate, but of course we love if you do. And then for those of you that are on that are not PitchBook subscribers, again, it is a give to get model and you do get a subset of the results that are all the data from today. And that is in aggregate with no individual name shared because we know there's a high level of sensitivity around the comp data. So without further ado, so we've been doing this now for almost 30 years here at J.Thelander, and we cover the investment firm compensation as well as salary increase and bonuses, really a whole host of different types of topics covering, because it's not just about the base pay and bonuses and total cash and carried interest percentages. There's a lot more that goes into this around vesting times, around hurdle rates. Rachel's going to get into all the fund formation and the other components. So all of this data was pulled yesterday. We have real-time platform, which is that's sort of the pluses and the minuses of running a survey, right? Is that it goes onto our platform. You got to take the time to update your data and keep it current, but it does help us have real-time data. So just by way of some background here, our platform covers, predominantly venture capital, 44%, but you can see there's a healthy mix of a little bit of everything. And really the best way to look at everything is the value of assets under management. And Rachel, I'm going to let you jump in here as well, because you do a lot of different advising and clients and the assistance with fundraising. And I know that you and I discussed there's quite a big difference between a fund with smaller assets under management, and you even intimated that earlier in our discussion. So give us some guidance in terms of what you see the differences are between early funds versus later funds in terms of how they're structured.
Yeah, so of course, earlier funds, if you're looking at the 7% less than 25 million, that's generally going to be a fund one, an emerging manager just starting their first fund. And they're not going to have a lot of management fee to hire a humongous team, right? So it's going to be maybe one or two managing directors, right, that are making all the investment decisions, doing all the fundraising, really stretched thin with some, maybe a few employees and maybe some venture partners or scouts or consultants. But that's going to look very different from a fund 15 or a fund 20, billions and billions of dollars under management and 50 employees. And I think it's really, I get asked this question all the time by emerging managers is, what's our range of carry? What's your range of vesting? And that's why it's so awesome that you get to participate in this survey and get a subset of the data for free, because this is what, Jody and her team do day in and day out. So the other thing I guess I just mentioned is obviously for the huge firms, as you're
which are growing, by the way, based on what we're saying here, you can imagine, right? We used to go up to $1 billion plus, and then we go to $2 billion plus, and now we're at $7 billion plus for exactly what Emily was saying, is that these larger funds are raising more capital, and it's easier for them because they have a track record.
That's right. And what you see too is if you're looking at carry fund to fund and fund 8, 9, and 10, maybe there's not as much variance between types of employees and levels of employees because they've kind of figured it out and they're just rinsing and repeating with very large teams. And between funds 1 and 3, there's quite a lot of growth in the firm, and those decisions you're making early on are so important.
Yeah, so you can see how many funds are currently being managed. So our data set covers a very broad range, but it obviously impacts the compensation. And then here's by total AUM, how many funds are currently being managed. So the less than 500 million, and then the 500 to a billion, and then we show you a billion plus. And with the billion, as you can imagine, with the more higher assets under management, there are more funds that are being managed. Location of firm, this comes up all the time, and we have a global data set, and we're growing even further globally because we've had a lot of activity right now in the UK as well as the whole of Europe. And but specifically, the UK market has been very active because, and I don't know, Emily, I don't mean to put you on the spot, but we know there's quite a bit of money coming in from the UK pension funds. Is that something you have any, input on?
I just cover US, but PitchBook does have UK data, and feel free to follow up with me if you wanted insights on that.
Yeah, because we've seen that there is, assets coming from the multi-billion dollars coming from the UK, the pension funds, and that's going into investments. So there's quite a bit of activity, and we've spent some time there. And then in addition to that, within the United States, we cover the country as well by the different pockets. And we don't see a very big difference in terms of data that is domestically. It's really more by assets under management. Rachel, thoughts on that?
Um, yeah, so I mean, I think again, it's just the size of the team, right? The number of folks you have working for you, what types of hats these folks are wearing, how many jobs they're doing, right?
Right. Right.
So
And it can be the competition for talent can random. I mean, obviously, we know there are places like the Bay Area and like New York and Boston. Then there's also Chicago. And there can be, crazily enough, more competition for talent sometimes in places that you wouldn't even think about because it's just harder to find the talent there. So it's not always consistent that it's geography based. And you could use it for one, position, but not for every single role. And then here's our last slide sort of on background, and we're going to delve into the data because we know in terms of compensation and how the firms are structured. But within Europe, you can see these sample sizes now are heading up towards 100, which is great. And then this is another area that we talked about is the list of investment firm positions. And Rachel, when you saw this initially, you were like, wow, there are a lot of jobs, and there are a lot of jobs. And we are seeing that there is not only investment professionals, of which we start at from associate, senior associate, all the way up through the managing general partner, but now there are multiple layers of operators, right? We have chiefs, VPs, directors, managers, and even associates that are covering all these other areas in terms of portfolio services and services to provide with inside of funds. So, Rachel, as you're working with firms on all stages of their development, what are you seeing in terms of, your own experience and the market with these other roles and how funds are structuring themselves?
yeah, I think the devil is always in the details, right? It's all about, right, in terms of titles, like what are the people's actual duties? And so it's really helpful to have these broad sets of data in terms of like director, level, junior director level, but then also to like understand what are people actually doing within these roles. And the larger the firm gets, of course, the more spread out the carry is, the compensation is.
Exactly.
But it's really helpful to see these titles. And then it's also helpful as you're advising clients to dig into what are actually these people doing and what comparables do we have, for other firms.
Talk to me a little bit about a fund that maybe is on fund 1 through 3, because we discussed this as well, and we're dealing with this with a couple of clients right now on the consulting side. So you set up your fund structure with the cash and the carried interest mix in maybe fund 1, 2, or 3, but that can look very different if you're in terms of the percentages of carried interest. Let's say the firm is really successful. Maybe you can't sustain having those percentages as you grow and have more assets under management.
I think that's right. Right. So if you have like funds 1 through 3 and you've got, the managing directors maybe having 80% of the carry, right? As you grow and you need more people, right? Maybe that goes down a little bit. And in funds
Right.
1 through 3, I see also an interesting split between the carry and the capital commitment, right? So when you're first starting out, not everybody on the team has the net worth or the wealth to fund the capital commitment. But as you get into these really huge firms, you tend to see much more capital and carry split pro rata. So for example, if you have an employee that's getting 5% of the carry, they also have to put up 5% of the commit.
Right. That's the way it typically would go, is that it would be, that's sort of the golden rule, is whatever percent of capital you have to contribute is also the percentage of capital that you get.
Right. But in earlier firms, sometimes people just don't have that capital, right?
Right.
It's just not like possible. So you see much more just, hey, front loading of carry, let's get this going. And then we expect a lot more, commitment as we are in this together longer.
Yeah, so here's a chart on this section that we're getting into now is sort of firm structure and promotion. And so this talks about the different assets under management and how a firm is structured. And of course, we can get into customizing this and running more detail around the compensation on a firm by firm basis on the consulting side. But for overview's sake, this shows you for a smaller fund with less than $500 million of assets under management, obviously very partner heavy, because they are trying to invest, deploy capital, and then go ahead and get some kind of return. And you can see that these other roles, the junior partner, other investment professionals, venture partners, operations, finance, and administration, is a little bit less. And then that gets nuanced as you raise more capital. Obviously, you've got to build more back office. So give us a perspective from your angle on this.
Yeah, so I think, honestly, in funds 1 through 3 or whatever, you see a lot of outsourced CFOs, outsourced back offices, and in much more established later stage firms on the right, you see that flipped. You need a lot more operations. You need really high quality finance professionals. There's just a lot more work, and you're willing to pay a lot more for those high quality people, and you have the capital to pay them. So there's just a real swing in kind of outsourced versus inside the house, I think, back office and operations as you grow.
Right. So here's the firm headcount to segue into that. Here is initially you're under 25 employees, and then you get to grow a little bit more. You're getting into the 25 to 50 employees. And then you can see once you get into that $1 billion plus, the headcount's really starting to grow. And this obviously is very relevant in terms of your comp structure and how you're looking at the cash into the carry, because it's really important. Because if you look at this, payroll is extremely big, right? So you can see that the average payrolls now, if you're getting more than 1,037 people, the average is over $13 million. So it gets into be a big piece of this. So, and here's what was your total payroll cost as a percentage of your firm's total fees and revenue. And you can see in some cases, it's all hovering around close to 45% or half. Okay, so let's talk a little bit about promotion, because it's on top of mind for everybody, around how long does it take someone to get promoted. So we looked for these different roles: senior managing director, senior partner, managing director, director principal, senior associate, all the roles where obviously you want. And you can see that the more junior the role, the shorter period of time it takes to get promoted. Right. And then I'm going to move to the next slide, because in terms of their total cash, I think this part is interesting. So this shows you that the total cash for director principal, VC, by years before promotion. So here's the director principal. So we're saying it's on average 4 years, and it's pretty stable, 3, 4, 5 years. That now you're looking in terms of the compensation, that by all assets under management, $300,000 is the 1 to 3 years is the total cash, which could be a combination of base and bonus or just base pay. There's no carried interest distribution in that. And then you can see, though, that the people that it's taking less time to promote, that their compensation tends to be a little bit higher. So I think that takeaway here is that if you are watching this and you see that you're struggling to have your compensation, it's possible that your path to promotion might be a little slower than you had wanted, because the firm is either not having success raising capital, or your role is staying, I wouldn't say stagnant, but you are where you are, and the opportunity might be a little bit less. Rachel, while you jump in here, I'm going to look. I can see that we have several questions, and I think one of these is coming to you. Is that, are you seeing carry in earlier funds 1 to 3 being awarded, or is it paid in capital? So if you get 1% of carry percentage, your commitment also 1%. I think that's what you were saying, but maybe you can answer that directly.
Yeah, I think in earlier funds, I'm seeing the managing directors, right, the most senior folks carrying a bigger load of the commitment, right, because they presumably have more net worth. They've maybe been in this business longer, right? The more junior folks maybe just can't do it. The other thing to consider is, are you using cashless contributions? That's another, we could dive into that. But if you're using cashless, a lot of times just the owners of the management company are using the cashless, and that means you're taking in less management fee and you're using part of that to fund your own commitment. And so typically only the most senior folks are doing that because they're going to be around the longest, presumably, and you don't want people kind of moving in and out and taking advantage of cashless. It gets real complicated. Later on, you see a much more like aligned, right, pro rata.
Right.
Hey, your commitment is the same as the amount of carry you're going to get, and we expect you to have the same amount of pain as the benefit you're getting, and it really just aligns incentives, right? And that's what everybody's looking to do with comp, is aligning incentives across the board.
Absolutely. That's the name of the game. I'm going to show this slide and then I'm going to have a question on this for you, Rachel. So this is talking about the finance bucket here. And the question was, does the finance category of expense include fund administration expenses charged to the funds or only employee charged to the management company? So from my vantage point, that only includes the employee charged to the management company and not any other fund administration. Emily, do you have a thought on that? No. Rachel?
Yeah, I'm not sure I understand the question exactly. Sorry.
So with this, the fund administration, hang on, let me pull this up again. A lot of questions coming in. So this side of finance, what we're including here in finance, we're looking at this when we present this as
employees,
just employees, yeah.
Yeah, that's right. That's right. Because that's how you're tracking the data from the firms that are participating in the survey. Yeah.
Right. Okay. And then someone wants us to go back to the senior associate slide. Once we get started with the comp data, we know. So let's look at the senior associate slides. Here's director principal. Here's senior associate. Okay. So this is the V. Okay. First, I'm going to predicate this with, so for senior associate, the N is meaning we have 153 data points we answered this question. And you're seeing, which really here is very stable, is that it's the 2 years, 2 years, and then 3 years. And then here is the comp slide that goes with that. That's for promotion, right? So now aligned with that, we're saying the VC by years before promotion, and we're looking at the total cash, which again is a combination of either base and bonus that was given or just base pay. If there's a carried interest distribution, it is not included here. And you can see that the compensation is for the less than 500 million is consistent, right? $180,000. And then for the 500 to a million, excuse me, just under $1 billion is the 217 annual versus the 199. And then it goes up a little bit, 240 to 250 with the $1 billion of assets under management. And that you can see though, in this area, the 500 to the just under $1 billion is that the person who is fast tracked where it's taking less, they're making more money, which I think makes a lot of sense, right? Okay, I'm going to move on to the next. Here is the same information for associate. So you can see that the more money you're making in the 1 to 2 years is the more money you're making, the faster your promotion is because you are deemed sort of the high potential. Okay, let's look at some real-time compensation data. This is everybody's fun part here. So let's go through the discussions. And Rachel, I'm going to let you talk about the carried interest and carried dollar to work explanation. So we look at J.Thelander when we survey, for those of you who have participated and will participate. So base salary is your current base salary. Current bonus means that it was awarded. And the target bonus means it's what's set on the horizon, which we know for these sort of mid-level and junior positions tends to be planned in advance versus the more senior roles. It tends to be if there are management fees left over or how well the fund did. And that gets you to total cash. And then the other incentive, carried interest, we define as a fund profit received as compensation once there's a certain threshold. Rachel, anything to add on that?
No, I think the obvious point is, right, you got to return the investor's capital,
right?
Generally. And so, you got to you're not getting any carry until you're in a profitable position.
Got my glasses. Yeah.
And so it really, I mean, it's really interesting to think about, okay, are you working at a $25 million fund or a $5 billion fund, and how long might it take to get to that point in what we call the waterfall, the distribution waterfall?
Yeah, perfect. We're going to get into that in more detail as well. And then the other thing that we've been surveying now, we publish on, is carry dollars at work. And we define that the total amount of carry one will receive if a fund achieves a 2x gross multiple funds. So, Rachel, I know this gets tricky, but in the simplest way possible, anything to add to this or to maybe explain it?
Yeah, well, everyone's always saying, okay, I have, let's say, 1% of carry. What does that mean, right? And so the carry dollars at work is just a really, good concept to say, okay, if your fund is returning, if you have a $100 million fund and it makes $200 million, right? What is that 1% going to be worth in dollars, right? And that's what really helps people kind of get their head around their percentages. It's similar to an option plan. If you have units of options, like what does that actually mean? Well, it all depends on what the denominator is and what things are actually paying out, right? So
yeah, exactly. And the equity distribution allows a firm to distribute a percentage of earnings upon the success of a deal versus an entire fund, right? And this has become, we've seen this, funny enough, I would have thought that this would have been used more for mid-level and down, but it's really used more at the top level. And as we're seeing here, we're going to get into, I want to get into one thing here. I know everybody wants the compensation. We're going to do that too. Hang on. Let me move into, as the vesting times are getting longer, right? Hang on. This is carry dollars at work. I want to move into the carry for 1 second. That the carried interest vesting times are taking a long time, right? And so as a result of that, there are sometimes equity distributions. So here is a slide on this. Then we'll go back to the comp. Keep everybody on the call with us. Okay, so here's the total amount of carried interest for the firm, and that's typically the 80-20 split, right?
Right. So you see that big 49% is 20 to 25% carry, right?
Right.
Yeah.
Okay, and here's the vesting time for carried interest. And this is year over year, 22, 23, 24. And you can see that this vesting times, how much are you seeing this changing in terms of when funds are starting versus later stage funds from your practice, Rachel?
Yeah, so it's interesting. This data is really interesting in the 10-year bucket, right? That over the last couple of years, more firms have gone to a 10-year vesting. And I think that makes a lot of sense, right? Because as funds are taking longer to liquidate and wind up, they're getting extended. Maybe a fund is around 15, 16, 17 years. You don't want people walking out the door in year 5 and taking all their carry, because who's left to do all the work? Right. So we're always counseling firms on, okay, when do you think, you're going to have carry distributions, and when, how long are we trying to incentivize people to stick around? And these funds are taking a lot longer to wind up, and you want unvested carry to give to a new hire if people are walking out the door early in the fund's life. So the vesting conversation is probably the most important conversation we're having with a new client. I've even had clients come to me and say, we switched law firms because nobody talked to me about vesting of carry. And so it's just so critically important to understand the lever there, what the cliffs are, how, over what increments do people vest, what's market, and what kind of fund do you have? A fund of funds investing in other funds is probably going to have a slightly shorter vesting schedule than a pre-seed, very early stage venture fund, because those deals aren't going to liquidate for a really long time, and you're going to be doing follow-ons maybe into year 7, 8, 9. So the type of fund you're managing and working at also matters a lot.
Right. So talk a little bit about, let's say you're on a 10-year vest and you have vested 9 years through. What happens with your unvested carry if you leave? Do you have to be present? And what happens with your vested carry? Do you have to be present to win? Or how often are those clauses put into firms?
Yeah. So if you leave after year 9, right, and you said you're 90% vested, then typically you get to walk away with the 90% of the carry. And there's always a question of, are you treated as 90% vested from day one? Right. Retroactive.
Do you typically see a cliff for the vesting?
Yes, we do typically see a cliff for the vesting, a 1-year cliff. And it's pretty interesting. Sometimes that's getting longer, maybe 18 months. Particularly maybe when you have a bunch of new hires, because you're not quite sure how people are going to work out.
Right. So it's
And
very
so,
similar to the portfolio companies, right? Typically, well, they have a 4-year vesting, but a 1-year cliff.
right, right. At least a 1 year cliff. Sometimes we see a little bit longer. But basically, that's before you start to get any vesting at all. You want to see are people working out. You know, you don't want people walking out the door in month 6 and taking a bunch of carry that would continue. So anyway, so the 90% vested, typically you get to keep that. The unvested, you just lose.
Right.
We also see some repurchase rights now. So like it depends on why you leave. If you leave because you just quit, or you terminated for cause, or you go and compete, or take investors or employees, like those bad leaver kind of situations,
Right.
then we see actually you could even lose vested carry, and you're not going to get any more distributions after that, and you may even have to give some money back. So the devil is in the details.
Right.
But
I've
seeing
seen
the
firms that have
data
had
is very, very helpful.
I've seen firms that have had partnership agreements when they raise a fund saying that you basically have to be present to win. So there are a lot of nuances around this, I would expect.
Yeah, a lot of devil is definitely in the details, but it's so important to think through it.
Well, that's why
Because
they
you don't
to
want to
you.
be thinking through it when somebody's leaving.
Right. That's why they come to a firm like you. Let me ask you this. Do you do the employment agreements as well, or can you double dip on both sides, or no?
Yeah, so we have a fabulous employment team, a whole team of
Yeah.
employment lawyers, as well as a comp and ben team. So the employment lawyers help draft all the employment agreements and the separation agreements, and we work hand in hand with them. The comp and ben team helps a lot with 409A issues, potentially even some carry. We haven't talked about this yet, but some carry gets pushed to the management company to then be cashed out and given as like phantom income. And there's 409A and other complex tax issues with that. And so our comp and ben team help think through those. So we have
But they can
all
also,
sorts.
that's where you being a partner, they can come around and ask you as well what you're typically seeing, because we are getting questions sort of on what the standard cliffs are. And we see that it is a 1-year cliff.
Yeah, that's right.
Yeah. Okay, perfect. I'm going to move back to, here's the percent of the cap. I'm going to move back to some comp data because I think that's important. And before you know it, we're going to be out of time here, which is how it goes. So I'm going to move back to the comp data because I know people are interested to see this. So, and then we can move into the carry dollars at work and equity distribution. What I was saying before, actually, I meant to discuss this and how we got into the carried interest is because the vesting times are taking longer, we're seeing some equity distribution inside of our clients because, and also that the emerging funds are raising capital for each deal versus because they're not able to raise a fund. So they're getting a little bit of the opportunity to raise capital just for one investment, and then they get a distribution on that. Are you seeing that much, Rachel?
Yeah, for sure. Because I think the whole part of being an emerging manager these days is it's really hard to get capital. And so if you're just not seeing that fund come together, you're saying, okay, well, look, I have this awesome deal. Right. There's a lot of excitement about it. I have access to the deal. I'm going to raise a mini fund or what we call an SPV just to put money into that one deal. The beauty of that for the investment advisor and the fund manager is if that deal hits, then you get 20% of that upside on just that deal. And so there's a lot of money to go around, or whatever the carry is. Maybe it's 10%, maybe it's 15%, maybe it's 20%. And you don't have to offset your losers against that because it's literally just a one deal by deal SPV. And then you use those to build a track record to then raise fund one, maybe in 3 or 4 years.
Right. Or, I mean, this comes up as well. At some point, you got to look to make sure that people have enough carry, and maybe you use private company data as well to look at the percentage of equity they might have, because it gets trickier to structure it because it's not as traditional. We are having a couple questions here. Is vesting usually deal-based or employee-based? 4 years start from the first day in the company, or do we have a 4-year vesting for each deal started from the deal close date? So first of all, we don't typically see the 4-year vesting. We're seeing longer vesting than that. I would say a minimum of 5 to 6 years. And then the question, this one would fall to you, Rachel. Are you seeing this from each deal started from the deal close date, or what's the typical clock? When does the clock start ticking?
Yeah, so if we're talking about a fund, which is a pooled asset vehicle, a lot of deals in that fund, we typically maybe see it start as what we call the activation date. So that's the date you actually activate the fund and call capital from your investors.
Right. And
okay, so some people
that's
form funds early and then they wait to activate them just so they know they have that dry powder. But we typically see that vesting commencement date, we call it, as of when you're calling capital for your investors because you're going to do your first deal, basically.
Right. So that doesn't have anything to do in terms of the, and so it is fund based, not employee based.
Except if you're a later hired employee and you're coming in at year
Correct.
3 of the fund, then you're not going to get vesting back to when the fund started. You're going to get that vesting about when you started. So it depends.
Right. So here, let's look at this. So I'm going to, and then we have another question on the shadow phantom carry, but this goes back to there we go. There's so much, we need to do a webinar just on carried interest. So here's what percent of the committed capital the GPs have to contribute. And this is what we talked about. This is where of the 80-20 split, 80% of the money coming from the LPs, 20% coming from the GPs. This is what percent do they have to contribute of the fund?
That's right. Like, Jody, if you have a fund, how much of your own money do you have to put to work in that fund? And you see the range from 0% to more than 10%, I guess, right?
Right. Yeah. And then here's all firms. And then here, what percent of the capital does the investment professional contribute to the most recent fund for their carry? And you can see that these percentages, obviously, the more senior they are. We're not giving you everything here because we want to motivate you to participate. In case we haven't said that enough, I'm going to say it one more time, because all of this is an investment firm subscription. We give you the details here, and then talk about the waterfall. But the reality is that with the vesting times, you contribute your capital, you have the vesting time, and then that is when the fund starts to, you sort of close and you commence on the investing, and you have your capital calls, which also can include contributing capital at your level. And that in turn gets you the carried interest. And then if you come in later to a fund that's already started, then you get a prorated share of that. It's going to be depending on your job level, depending on how deployed that capital is and where that fund is. And then you would potentially participate in the next vintage.
That's right. And there's a tax issue there too. If you're coming into a fund 5 years in, and you want a carry grant, they might say, no, you need to wait till the next fund, because if the fund is what we call in the money, meaning if you sold all the deals tomorrow on the unrealized basis, and then there would be like $10 million of carry. If you get a piece of that, you're going to be taxed on that. Right. And so nobody really wants that. There's ways around that, a book up and a catch up and various complicated accounting ways to deal with that. But it might just be that it's way easier for everyone to have everyone come in at when the fund starts, and maybe you just have to wait till the next fund, or maybe you're getting a smaller piece of the carry and you are getting it at that hurdle level where the fund is at its marks then. So
yeah, we had a question on that. Is there any data on how carry is granted when new employees join? Basically a case when the carry is granted across all existing funds versus fund currently being deployed. And it's a great question. And we do customize the data for this, but we do only survey and have the data on what your total carried interest would be based on the current assets under management. So if you're coming in later, it would be a prorated share, and that's really done on a firm by firm basis. There's no really sort of whole golden rule, but it would be a prorated share and really up for negotiation. But I would want to know what I should be getting if I was coming into a current fund as relatively new starting, and then I could understand what I might have as a prorated share based on a fund that's already been raised and partly deployed.
Yeah, and I think it's a bespoke negotiation, frankly, in terms of which funds are you working on, which, are you coming in to sit on boards of prior funds, or are you just kind of working on the fundraising for the newest funds? So it all really depends on kind of what you're coming in to do.
And depends how senior you are, because there's no question, and I'm sure you can attest to this, that it's very complicated and no two firms are alike. And the way that they set up, especially for the senior people, carving that pie is all very different. Once you get to the mid-level and down, where your carried interest is a very small percentage, or that's why you use carry dollars at work, there's really not a lot of flexibility for the firm, because in order to keep you, you have to be able to get, what's market. I'm going to go to the waterfall because I think this is interesting interesting to see. We did have a question on shadow phantom and synthetic carry. That really falls more into the corporate venture arena, and we do have that data, but it's not really used as much to have shadow and phantom. We're doing a webinar for that on March 6th, and we will make sure that everybody who signed up here is on here asking these questions, that you're familiar with that, because we really do delve into shadow, phantom, synthetic carry. It's not used as much. I don't know, Rachel, your opinion inside of a venture firm.
Yeah, it's not as common, although you do see it sometimes to issue what we call deal by deal, like incentives, right? If you have a scout or an advisor just helping on one deal, you kind of can push cash to the management company to pay that person a bonus depending on how that deal does, but you don't know how that deal is going to do for 6 years. And so it's used as kind of a mechanism to incentivize just very specific types of people, and much more obviously common in CVCs across the board.
Yeah. People are asking us for investor relations data. So as a sensitivity of time, you can see we have so much information here. I want to make sure that people are getting what they want. And then we can go into the waterfall questions as well. But people are asking about VP of Investor Relations. So these are the comp levers, as we talked about, base pay. And here's the actual bonus, which means it was given, target bonus, which is what's on the horizon, and total cash, as we said, is a combination of base pay and bonus if it was paid, which is why the base pay plus the actual bonus does not equal total cash, because it's not the same sample group. And we show you median and 75th percentile, and the percentage of carry a little closer with the median and the 75th percentiles. And we can, on our platform, you can also customize these by the total assets under management and so on. But this gives you an idea. And here's a talent partner job as well. We show you the maximum number because there's always someone, a talent partner who's, making over $1 million, who's on this call saying, well, that data's showing I'm overpaid. So we want to make sure that you're seeing, because max numbers are real numbers. Max numbers are not outliers, and that's another strength of the J.Thelander data, is that this is not some plug into payroll, software. That's why the survey participation is really important, because we're able to see all of these numbers, and we really level the job titles to make sure that they are representing the market, and that the outliers, if someone was making $5 million, we might drop that number, because if the next number is 1.2 or 1.3, then we keep those numbers because that's where data is hovering. All right, I'm going to move back to the waterfall because I think that's really important. And then we're going to look. So we're back to the carried interest, because it came up about the waterfall, and I think it's really relevant as a component of how the carried interest is structured. So Rachel, back to you.
Yeah, so this, I think, goes back to the type of firm, right? In a private equity firm, typically you might have like a deal by deal waterfall, which means like you get paid on your first deal. You're putting a lot more capital to work in each deal. And if that deal exits, then you're going to get carried right away on just that deal, subject to a bunch of different complex factors. In traditional venture, you have to return not just the first deal, but you've got to return the investors all their contributed capital. Right. Which might take 5 or 6 years, even if you had some really big winners early on.
Right.
And then you're starting to see carry. So I think in the venture game, you start to see carry distributions come out later in the fund's life, generally.
Yeah.
In a deal by deal model or a single deal SPV, like we talked about, you could see a big carry distribution in year 2.
Right.
And
so here's the what type
of
waterfall. Here's the specific on that. Maybe this gives you a little more to talk about.
Right. So the deal by deal, it's just easier to say deal by deal. The private equity waterfall is, 28% of your survey data, right?
Right.
And then European, which is not surprising because that's VC growth, secondary fund of funds, like all these other type of funds that you put up at the beginning, typically have a return of capital or European waterfall. So the carry distributions just generally aren't going to come out until a little bit later.
Yeah. I mean, that's part of it, right? I mean, not all VCs are having carried interest distributions and have had that wealth creation. And that is really, well, I guess we'll wind this back up a little bit to go to, but really what Emily was saying in the beginning is that it's taking longer and funds are having a harder time, raising capital. The elite ones are doing extremely well and the emerging ones are struggling a little bit. And that the path to liquidity is taking longer because the markets are staying private longer. It is impacting compensation for all of these reasons here. I'm going to show one last slide and then we'll do our recap here. It's just a little bit of comp data to keep everybody focused on here is that you can see that this is the year over year median cash and carried interest distributions for a venture capital for for a director principal. So this is a very solid mid-level job. And you can see that the total cash, which is the main thing, exactly what Emily was saying is that things have leveled out a little bit again from 2024. This is showing the actual bonuses is hovering around 462, 450. And again, this is the median, and that the carried interest is up a little bit. And then here is the 75th percentile for those same job numbers, just so you get a handle on to see things have really, so things were up a little bit in 2022. They moved a little bit down in 2023 because in general, the markets were a little more challenging and things have rounded up or stayed stable since then. We've got a lot of great comp data. We'd love you to participate. And I'm going to pass it over, Rachel, if you have any. So you heard all this back and forth today. So what's your recap, your words of wisdom, any parting things that you think important for the audience to know and remember?
I think, this is an awesome industry, right? It's times like these where you're investing in great companies that are literally going to change the world in 5 or 10 years, and you're going to make a ton of money. You just got to sit tight, be patient. Surviving is thriving, and believe in this industry and the power of backing these amazing entrepreneurs. Like, the money will come. It might just be taking a little bit longer, but that also means private company valuations are settling down from where they were a few years ago. And ultimately, in 10 or 15 years, these funds and these firms are going to make a lot more money. So now is a great time to be investing and to be working in this industry.
Emily, any recap from you from the PitchBook side?
I would just say that we are cautiously optimistic for 2025, which is a great narrative shift from last year, where we saw small signs of recovery, but not enough to really call a rebound. So we will see how the rest of the year plays out, but so far, things are looking upwards.
That's great. Well, thank you all for this. I agree. It's a long game. You got to stay the course. Having great data is only as good as you know how to use it. And that's why, true to the PitchBook model, we have data and analysis. And Cooley being such a rock star firm, and Rachel, long-term partner there who's really grew up in the firm. We appreciate your expertise in PitchBook. Of course, the data analysis, and we are the sort of third prong for that here at J.Thelander. And we've really been growing the investment firm survey and data because it is a real career track. It is an industry that supports this entire private capital markets and the emerging companies. And it's an industry, and we want to make sure that you're armed with great data. So with that, we will follow up and send you the recording. If you have any questions, please let us know. And we appreciate your time on the webinar today. Thank you.
Thank you.